Good morning, everyone, and thanks for joining once again for the Learn and Grow Meetup. Super excited to see you all today. And today we have a very special guest with us, my good friend, Yona Weiss. Welcome, Yona.
Hello, Vinky. So glad to be here. Thanks so much for inviting me.
Of course. So a little bit about Yona. Yona is a powerhouse with property owners' tax savings. As business director at Madison Specs, a national cost segregation leader, I would say cost seg king versus leader. He has assisted clients in saving hundreds of millions of dollars in taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor and host of top podcast, Weiss Advice. So today our topic is going to be geared towards cost segregation. But before we get started, I would like to share a small little disclaimer. So this session is strictly for knowledge sharing purposes and should not be considered as a legal, accounting, or investment advice. And if you have any specific questions regarding any investments or any legal questions, please reach out to your CPA or your investment advisor. So, Yona, back to you. Stage is all yours. So you have the sharing session. Please get started.
Thank you very much. Appreciate it, Vinky. And great to see so many people coming out here on a Thursday morning, afternoon, wherever you are in the world. I appreciate it. I would love to get a little audience participation on this. I know there are some people watching the recording, but those of you who are here live, please let me know in the comments. I'm going to ask a question. I would love for you to give a one-letter answer. Okay, or one number answer. Let's do numbers instead. Numbers are more fun. So we're going to talk about cost segregation today. I'm about to share my screen, but while I do, tell me what your background, what your existing knowledge of cost seg is. So number one is going to be, this is the first time you've ever heard of it, right? First time you've ever heard of cost seg is Vinky announced, we're going to have this webinar. Put the number one in the chat. Number two is you've heard cost segregation. You've definitely heard it come up before, but don't really understand it. And that's, usually the majority of people. Number three is that you have a really good understanding. You may, in fact, have actually used it yourself for your properties, this tax strategy. So again, number one, just put there if this is the first time you're hearing it. I just want to know kind of where we're holding here, everyone's level. Number two, which is usually the majority, heard about it, of course, bonus depreciation, but don't really know what it means, what that's all about. And then number three, you've actually used it yourself. So we got Kevin, obviously, has used it and understands it a little more thoroughly. And then number four, if you are actually the real cost seg expert, I will give you the screen to share, and I'll just sit back here with my AI bot and I'll comment. No one? Okay. Sometimes we get like a 3.5, someone wants to say that, but no. Okay. Well, I'm really grateful to Vinky for bringing me on today and allowing me to share the stage and share the knowledge, because this is a topic that is really important if you are investing in real estate. And like we see from the comments, and is the general consensus, most people really don't understand it. If they do, they don't understand all the nuances and intricacies that come along with it. So I'm going to do my best to share everything I know about the subject in a condensed in about how long we have, 20 minutes?
We can go 30 minutes, 35 minutes.
Okay, great. 35 minutes. I will, basically just upload my brain on cost seg into this presentation here. So let's do this. We are on screen number 2 here, I guess. Okay, you guys see my presentation here. The truth about depreciation and cost segregation. Yeah. Okay. I want to make sure everyone is alive and listening and not multitasking, because this is something that tend to talk a little fast. So you got to stick around and pay attention. Also, please put in questions that you have in the chat over here. I'm going to keep it open. I'm going to be monitoring it, and would love to answer any questions, whether immediately upon, coming to that question in the middle of the presentation, or we will get to it at the end. But I promise all the questions will be answered, as long as they are related to cost segregation, that is. I can't answer everything. Anyways, great to be here. A little bit about myself. Vinky introduced me. I work for this company called Madison Specs, the biggest national cost segregation company. And yeah, let's just jump right in here. So we're going to talk about cost seg, as the cool kids call it. But we're going to understand what depreciation is in general. Okay, then what are the benefits, including benefits for an active investor, passive investor, what's a real estate professional, bonus depreciation, which is this thing that keeps coming up in the news, who should be doing this, when you should be doing it, really everything you can want to know about cost seg. And then we're going to do a short case study of a multifamily property. Put in the chat over here also, those of you who are, number twos, number threes, if you do invest, are you an LP, GP? If you are, active on single families, multifamily, just, while we're getting to know each other a little bit here, I'd love to know what kind of real estate experience you all have. And we'll get in there. Awesome. Some LPs, some GPs, MFRE. I guess that's multifamily real estate GP. Okay. That's good. LP and GP. Awesome. Awesome. So we got people all different sizes, small multifamily. Very cool. So GP is general partner, LP is limited partner. For those of you who didn't know that, FOF, you'll have to spell that out for me. ED. I guess, with the initials BD, I guess you're used to abbreviations, but I'm not. So you can spell it out for me. But either way, let's jump in here. Depreciation. Fund of funds. There we go. Okay. Funds of funds. That's lots of fun. You put the fun in funds, BD. Okay. So let's jump in here. We got, all right, Kyra is LP and GP. Depreciation. Most people know what this is. And if anyone has owned real estate, you know what depreciation is, but it is a borrowed term. And I want to emphasize this. Depreciation, the definition, does not mean that something is going down in value. Okay. Even that's what the dictionary definition is actually not what it means when we talk about taxes. It's a borrowed term that says that you're able to take a tax deduction based on the principle that things go down in value as time goes on. And so you're able to essentially write off the entire value of your property over a certain period of years, 39 years for commercial properties, 27 and a half years for residential properties. But again, it's not intrinsic to the property because this depreciation starts over every time that property changes hands. Okay, so if you sell it to someone else, they're able to start their new depreciation schedule brand new when they take ownership of the property. And this is really important when it comes to cost segregation because all of this is going to start over brand new when we have a change of ownership. So depreciation doesn't mean it's going down in value. It's just a borrowed term. It's a name of a tax deduction that allows you to write off the entire property from your taxes, essentially from your income taxes. But like I said, it's a long time, right? You take a property and you got a little bit of deduction every single year. That's going to take a while to write that all off. And most people don't like to wait that long. And so there came along this really cool, really in the 1980s was when this was introduced for the first time in this current form and allowed you to accelerate depreciation of certain components of the property. And it actually used to be called component depreciation, which makes a lot more sense if you ask me. I mean, component depreciation is just like, that's exactly what we're doing. As we're going to see pretty shortly, we're going to depreciate different components of the property that depreciate over a 5-year or 7 or 15-year schedule, essentially saying that there are certain things in the building that go down in value faster. Okay. And we're going to show you what those are shortly. And so that's what cost segregation is in general. It's a tax planning strategy that allows you to do that. So just to take depreciation in general to understand how this works, let's say you buy a building for $1 million, just a simple math exercise for us, not too complicated. Okay. So bear with me here. You're going to take off land. Land does not depreciate. So you always have to subtract something. I'm using 15% here because that's a pretty national average. However, there are certain locations where land will be much more valuable. Think about places like California, Vinky, right? Land is really high, right? Your land value is going to be 50% sometimes, which is crazy, which means that you're going to have less of a depreciable basis. But if it's only 15%, you're left over with $850. That means you can now depreciate or take a tax deduction of this full $850,000. How long does it take? Like I said, either 39 years for commercial properties and 27 and a half years for residential, including multifamily. Multifamily also fits into the 27 and a half year category. So essentially, what's called straight line depreciation, what every accountant knows is that when you buy a property, you're able to take a little bit for land and then put it on this schedule that says you can every year take a $21,000 deduction or $30,000 deduction, depending what it is. Now, that's great. If you make, $1 million property and let's say you have a net operating income of $50,000. Okay. That means that you're going to essentially reduce your taxable income by $20,000 or $30,000, which is great. So depreciation in of itself is usually extremely beneficial. Now, excuse me, that you may actually be making less net operating income, and you may have other deductions as well. So it's very likely, especially for residential properties, that you may have enough deductions to offset any income that you have. However, if you have other sources of income or you have more income from other properties, you may want to do this thing called cost segregation, which allows you to increase that deduction tremendously. So let's take a little example here. Let's take our example. We said straight line depreciation, remember, was $30,909, right? That was what it was without cost segregation. If you just did a simple depreciation. What we're going to do, and this is taken directly from our case study later on, we're going to allocate certain components. I'm going to show you in the next couple of slides what these components are. But just to give you an idea, 20% of the total property is actually going to go into what's called a 5-year property category. Certain components in the property, like appliances, furniture, fixtures, things like that, carpeting, can go into this. And the value of those components can be taken over a 5-year period. So again, we're taking 20% of the total value and taking that deduction upfront over a 5-year period. And the 15-year property, this can include landscaping, pavement, anything that's outside of the property. Again, $68,000 is a pretty hefty sum. So again, $238,000, instead of taking $30,000 a year, you can get $238,000 either in these faster categories, or as we're going to get to later on with bonus depreciation, actually all upfront as a lump sum. Okay, so cost segregation is going to double or triple your deductions during the earlier years of ownership, or even more so. So it's really more than anything else, it's like a time value of money play. And so we're going to talk about how this actually works and the mechanics. So I just wanted to give you just right up front, from out of the gate, what these numbers actually look like, right? Instead of $30,000 deduction, how about a $238,000 tax write-off? Okay, it's simple math, but it seems like, okay, and now you got my attention. How does this actually work? And is it actually true what you're saying? So yes, answer to both those questions is yes. So fundamentals, how does this actually work? It's an engineering process. So the IRS has required, engineers to actually take accounting of the property. So it's either through an in-person or a video of the property that they're going to analyze every component of the property and then reclassify those different components to these faster depreciation lives. Once we do that, we create a new depreciation schedule, a new essentially form that shows you how much you can deduct every single year. So what we're doing again is taking from this pool of potential deductions, okay, that $1 million, $850,000. And instead of taking a little bit every single year, we're going to pull from that pool to get you bigger deductions in the earlier years and front load some of those deductions. And it's done through, like I said, engineering study of the property, which creates a very detailed report and allows you to claim those deductions. So I mentioned before, 5-year property, 15-year property, it's broken down into 4 categories, essentially. So you have category number 1 is the land we mentioned does not depreciate. Category number 2 we mentioned is the building, the structural components that depreciates on the 27.5 or 39-year schedule. And that's always going to be the majority of most types of properties, especially if they're structural. Walls, windows, doors, roof, foundation, right? Infrastructure, all that's structural. And so we're going to give a lot of value to that. However, these 2 other categories are extremely important. And this is taken from a multifamily property, but there are different types of properties or different categories in other types of commercial properties. But just to give you an idea, what's called 5-year property, things that depreciate over a 5-year schedule that we can take these deductions up front. There are things that you would think of as movable or tangible, but many of them are actually attached to the property and are nevertheless considered movable or tangible. And so this is where it becomes fascinating. Stuff like, carpeting or equipment, furniture, fixtures, appliances, those are, you understand, those are 5-year assets. Those depreciate fast. You have to replace them in a much shorter time period, right? However, millwork, right? Lighting, moldings, these kind of things that special purpose plumbing and electric and things like that, vinyl floors, all of this can also be considered. And like I said, many other things as well can be considered 5-year property. And so the value of all these components, once identified and tallied up, can now take that value as a deduction over this 5-year period. And the 15-year period, land improvements is very similar. Asphalt, pavement, right? Concrete, landscaping. If you have a swimming pool or playground, anything like that, all of that's outside, all of that depreciates, has value and depreciates on a 15-year schedule and is going to vary depending on the property type, right? These are categories and these are generalist, right? But every property is specific. And so the engineers are going to go in and identify what those specific things are. So you may have a multifamily property that's in a city and it's on a city block, and it may be, like a fourplex or something like that, you can imagine. And there's really just like a little tiny yard, maybe a fence, sidewalk, okay, to the street. There's not much land improvements there. So you're not going to have much going to this 15-year property. Whereas if you have a garden style multifamily property, similar to the ones that Finke owns, you're going to have, huge, a swimming pool, and you're going to have a big terrace and, maybe even a gazebo with a fire pit and a dog park, all these kind of things, you got going on. All of that is considered 15-year land improvements. And that can be significant, right? You can be talking about 10 or 15% of the total value of the property can be in these land improvements, which again, can depreciate at a faster rate. So this is really, really important to understand these concepts. And there are certain types of properties, like I said, that will have more or less of these on a specific case-by-case basis. So just to kind of recap, I know a couple of people joined a little bit late, but just to recap also, it's also always good to review what we're learning, making sure we're taking it in and moving on with it. So what we're doing, we're creating tax deductions. Okay, we're not creating deductions out of thin air, but what we're doing is front loading those deductions into earlier years. That's reducing our tax liability, okay, and is going to increase our cash flow, which, like I said earlier, the main benefit here is the time value of money, which says that $1 today is worth more than $1 5 years from now. So most accountants that I speak to, and I speak to a lot of accountants all the time, they talk about deductions and what can you defer and deduct? What are these things that we can do to make sure we're going to pay less tax this year? Okay, next year we'll deal with next year, or 5 years we'll deal with that 5 years from now. Maybe we'll make a plan to help make sure that we're not going to pay taxes or going to pay, as less taxes as legally possible in those years as well. And so that's really where cost segregation comes into play, where we are, trying to pay as less taxes as possible to increase our cash flow. Hopefully we can use that to reinvest and then compound that money in a way that we wouldn't have had we just paid those taxes. So who should be doing this, or who could really do a cost segregation study? The answer is anyone. Anyone can do a cost seg as long as you are a taxable, which means if you are a nonprofit or government entity, et cetera, you're not taxable. And that's included as well certain retirement accounts. They're non-taxable, which I know a lot of people invest from your 401k or self-directed IRA or a Roth IRA or anything like that. If you invest in real estate through those entities, you are not going to benefit from cost segregation study, which in turn, many syndicators who are bringing partners or being limited partners will either not do a cost segregation study when they have a lot of investors from retirement accounts, or they will create different tiers of investment or different asset classes, or what's the classes of investors, right? Class A, Class B, Class C, whatever investors, and each one will actually have a different return schedule, which can affect who receives the depreciation benefits. Essentially a great kind of hack to make sure that who can receive the depreciation cost segregation will get it and who can't won't. And so that's something you want to check with your, obviously CPA, want to check with your operating agreement when you are entering into a syndication to see what the depreciation allocations are. But then essentially, if it's owned by individual, if it's owned by a trust, a corporation, LLC, it doesn't matter. Anyone can do a cost segregation study. And it's just, the depreciation flows through that LLC, or flows through that partnership to the owners of that LLC or that partnership, and according to your equity or your amount of interest in the property or ownership, that's how much depreciation you'll receive. Okay, pretty simple. Any questions at this point?
I have one question for you, Yona, here.
Yeah, absolutely.
And I did talk to somebody before. Somebody mentioned that to me, that you are able to use your K1 against your self-directed IRA too, because you are liable for the UBIT or UDFI. So a portion of K1 should be applicable. So when you're saying that some of the sponsors, they just, kind of create different classes, whether you get the tax benefits or no, how would that work? Because if somebody's investing from their SDRA, they should be getting K1, right? Because if they're liable for the UBIT or UDFI, that should be taken care of at some point.
Correct. Yeah. And there are different retirement accounts. So just a simple SDIRA, right? Self-directed IRA, may be subject to the UBIT, and therefore you could use some of the depreciation against that. But other types, the QRPs, which are like qualified retirement plans, which are essentially 401ks, cannot, and Roth IRAs cannot. So again, check with your accountant, make sure you're using, the right type of investment. But you're absolutely right, Vinky. There are certain types of retirement accounts that certainly can be subject to tax, and therefore the depreciation can be used to offset that. So yeah, I appreciate you bringing that up. Janelle asked a great question here. When in the purchase process is it best to do the study? We do multiple study times or one and done. Awesome question. I'm going to get to that very shortly on the slide that says, when should you do a cost savings study, which is probably one of these slides coming up here. So we'll get to that shortly. But first, I want to talk about the real estate professional status. And this is probably the most important slide in the entire deck over here. And the reason why that is because, and I want to introduce you to, if you're not familiar with what's called, and we had yesterday actually on our meetup, Brandon Hall, who talked about the passive activity rules, and great CPA, the real estate CPA. And, most people don't understand what the passive activity rules are, meaning that depreciation or rental income is treated differently than other types of income. Okay. So I want everyone to understand right now that if you're making money, if you're in a W-2, and you can put in the chat over here, if you're a W-2 or you're a real estate professional, REP or reps or something like that, you can put in the chat if you know what that is. But essentially what a real estate professional is, and again, before I get to that, the reason why this is so important is because, okay, two different types of income. Let's just break it down like this. Real estate income is taxed in one way. W-2, 1099, other types of active income, portfolio income from stocks, et cetera, are taxed in a different way, which means depreciation can only be used to offset your rental income or your, what's called Schedule E, or your passive income. Even though it's not necessarily passive, that's how the IRS treats it. The only way, and there are a couple exceptions to this, but the only way that you can use this depreciation to offset your ordinary income or your W-2 income is if you qualify as a real estate professional. Okay, which means if you are a passive investor and you're not a full-time real estate professional and your spouse is not a real estate professional, that means that you are a passive investor. You can only use the deductions or the losses from cost segregation that you get on your K-1 to offset any passive income that you have, or passive gains if it's a sale of a property. That's a huge, huge, huge misconception. A lot of people out there think, oh, I'm going to invest in real estate and then I'm going to use all these deductions and I'm not going to pay any taxes. Well, unfortunately, that's not the case. Unless, like I said, you or your spouse qualify as this real estate professional. And I mentioned there are a couple other exceptions, but this, generally applies across the board. So now let's define what this real estate professional status is. And this is taken directly from the IRS publication. You or your spouse. So only one of you needs to qualify for this in order to get this benefit, which again allows you to use those deductions or those losses against active income. So you need to spend more than half of your time in the real estate trade or business, materially participating, okay? Which means you cannot have a W-2, you cannot have another full-time job, and also qualify for a real estate professional status, because the IRS cannot view that someone will work more than 40 hours a week. They just can't. They can't imagine, right? If you are claiming you have a W-2, you're working full-time, and also saying, even if it's true, and I know people that it is true, that they have a full-time job and they spend more time, they spend 60 hours a week, all the weekends, after work, every day, on their rental properties, self-managing and doing the construction and doing the maintenance and everything like that. Nevertheless, it's going to be very difficult or impossible to prove that you will get that if you also have a W-2. Just telling you, that's the nature of the IRS. The second qualification is that you need to spend more than 750 hours doing this profession. So you can't just retire. You can't just sit on a beach and not do anything and own some rental properties and you have a property manager doing everything, you're just collecting the rent checks. That's not called a real estate professional. You actually have to show that you are spending time during the year. And Brandon, who was on yesterday, like I said, reiterated over and over and over again how you need to actually have a timesheet or track this. And show that you are spending these hours. So Janelle said, do you know a good app? There's actually an app that was, it's called Reps Tracker. I'm actually following the lady who started it on Instagram, but it's Reps Tracker. I think that's what it's called, Reps Tracker. You can check it out. It's an app in the App Store and essentially allows you to kind of log in when you're doing different things in the real estate trade or business, so that's tracking your hours. So what is that called? Either you're developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing it, or brokering it. So anything involved with the actual operation, of rental properties. Now, if you are a broker or a real estate agent, you automatically or you work in a property management company, et cetera, or you manage property, you're automatically a real estate professional, right? But you also need, like we said, to materially participate. So it's not just that you are a broker. You have to have this what's called material participation, which means you have to actually spend time in these, rental or operating capacity. Okay, so there's a lot of rules to this. I'm just giving a high overview over here today, but it's really important, and you can check it out online. There's definitely more information out there. I'll put a plug to Brandon, as mentioned. He was on yesterday, to his podcast called Tax Smart Real Estate Investors. It's also a YouTube channel, ton of content around this specific topic over here, but really important to understand that unless you are a real estate professional or your spouse is, then you can get as many depreciation, you can get bonus depreciation, from here till tomorrow, millions of dollars, and it will just be a passive loss, meaning you can't use it in the current year against active income. It will carry forward and you can use it next year, and you'll be able to use it to offset the gains on the sale of the property, it's still good, still great. And I should mention, it's still amazing that you're able to use the cost segregation against your rental income, which means that multifamily or syndication or real estate investing is a great tool, because in of itself, you are essentially getting returns on the investment and not paying any tax on it during the life of ownership. So it's one of the most tax advantaged investments just for that reason. So even if you're not a real estate professional, it still is extremely beneficial. Just want to make sure that people understand that it's not what others might think it to be. There's one exception. There are a few exceptions I mentioned, but one exception is if you make less than $100,000 a year of adjusted gross income. If you make less than $100,000 a year of adjusted gross income, that means you're able to take $25,000 of these deductions, of these losses, to offset your W-2 or your active income. So even if you're not a real estate professional. So that's one example here of the exception to the rule. And if it's up to $150,000, it phases out. So if you make over $150,000, you cannot take any of these deductions unless you're a real estate professional. And then the other exception to the rule, which I like to talk about, and I did not include a slide over here, is what's called the short-term rental loophole. So if you own and self-manage a Airbnb, which the average stay is less than 7 days, and materially participate in running that, you can then use the deductions of cost segregation to offset your active income as well. So another, just kind of put in there, they call it the short-term rental loophole. We'll talk a little bit more about it later, maybe if we have some extra time. So we'll get to the Tax Cuts and Jobs Act. It's really important, but a couple of questions here. Janelle asked, do those, and thank you, Janelle, by the way, for being the most engaged questioner in this. I appreciate it. Do those tasks have to be specifically spent on the property? Yeah, generally speaking, yes. There are other types of activities that can be done. And I think I actually took like a screenshot yesterday of Brandon's presentation of what those activities were. But yeah, there are, most of the activities mentioned in the material participation are in fact dealing with the property itself. So yeah, I'm just looking at my over here, personal service hours spent acquiring the property. I'm just showing my, if you guys can see my thing over here. Yeah. Okay. Anyway, that was my screenshot from yesterday. Placing rental ads, showing the property, taking tenant applications, screening tenants, negotiating leasing, cleaning units, maintaining the grounds, doing repairs, doing improvements, supervising a property manager, purchasing supplies, inspecting the property, communicating with tenants, collecting rents, evicting tenants, traveling to your rentals. So all these things are considered personal service hours. So again, most of those things are dealing with directly involved in the actual property itself. What if one gets an extension, Ken asks over here, for tax filing and the K-1s have not come yet? It is a very common occurrence. Yeah, not really much you can do about that, unfortunately. You have to file. Most people who, if you are invested in syndications, it's very advisable to file an extension because most K-1s come very, 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 very late in the game. I still have not received most of my K-1s this year. We're in July. It's not too late. Usually I'll get them around like September 1st or something like that. It's okay. It's just part of the game. But yeah, definitely make sure that you file extension if you invest in syndications. But yeah, nothing really you can do except filing late, which may come with some penalties or anything like that, but not much you can do. So what's the Tax Cuts and Jobs Act? Bonus depreciation. So we've heard about bonus depreciation. Let's talk about it. Bonus depreciation means once you have done a cost segregation study and have allocated certain components to those faster lives, like remember those 5-year, 15-year, where's that slide over there? 5-year property, 15-year property, all this stuff. Once you've done that, you now have the option, instead of taking it over a 5-year period, these deductions, right? You can have the option to take it all up front in year number 1. That was called 100% bonus depreciation and applied if you bought a property between the end of 2017 and the end of 2022. You could take what's called 100% of those accelerated deductions in the first year. Okay. You can still do it, by the way, just so you know, if you bought a property between 2018 and 2022 and have not yet done a conservation study, you can still do, even for 2023 taxes, you can still claim 100% bonus depreciation because it goes after when the property was purchased and placed in service and not after the date when you're filing. Okay. So important note, most people don't know. However, this year, if you buy a property in 2023, it's phased out to 80% and will continue to phase out by 20% each year, 60% next year, et cetera. And it's going to keep going down. The remaining 20% can still be used over those cost segregation, right? Accelerated 5-year and 15-year categories scheduled. So it's not all lost. And cost segregation has been around for decades and will continue to be around. And I believe that bonus depreciation may even be reintroduced. In fact, it already passed. There was a bill a few weeks ago that was presented and passed in the House to extend a 100% bonus depreciation. It still needs to go through Congress, but to the Senate, but we'll see. Meaning it's out there and it's being talked about. So we will see if it comes up. Okay, now let's get to Janelle's question. When is the best time to do a cost segregation study? And I'm going to get to these other questions in a second, but I would love to just go over this slide first. When is the best time to do it? Really, it depends when you need the deductions the most, meaning you can get a cost segregation done at any time. It does not need to be done in the first year of ownership. It doesn't need to be done at all. Most people like to get it done in the first year immediately after acquisition, just to get things set up in the right way from the beginning in terms of the depreciation. However, it doesn't need to be. It can be done in the second year or third year of ownership, et cetera. Even if you've owned a property for many years, right? You can do what's called a look back study, which means we're not going to amend previous year's returns. All you need to do is to make an adjustment and fill a special form. It's called the 3115 form. It allows you to change the method of depreciation and catch up whatever depreciation you missed that you could have taken and take that this year. So it's like you're getting a lump sum of accelerated depreciation this year by making that adjustment. However, the only time that you would need to get more than one cost segregation study done on a property, like I said, you get it done in the first year on the acquisition. You bought a property for $1 million, do the cost seg, get that depreciation schedule. Now, what happens in year 2 if you do some renovations, or even in the first year? It's harder. It's a little more complicated if you're doing it immediately after acquisition. But let's say you're doing renovations. That's the only time when you're going to add to your depreciable basis, meaning you're going to add money to your depreciation, and you can do an updated cost segregation study. The depreciation basis does not change based on the appraisal. It does not change if your property goes up in value. It only changes if there's more money being added into the property. Okay, so it's a really important distinction as well. So again, if you do some upgrades, and we talked about this yesterday also, there's something called partial asset disposition. You can take things off the property, off your books, and then add new depreciation onto the books. So this can be done, again, on the acquisition. And then once you've done the renovation, after that's completed and placed in service, you can take the depreciation on that as well. Okay, it can be done in new construction. We're just, once it's placed in service, once it's ready to go and rented out, we're ready to be rented, you can do the cost segregation at that point. We're just going to allocate those costs to different categories. So I hope that answered those questions. Let's go to Aisha asked a question here in the chat, in the comments, in the chat. If cost seg is done for long-term rental property that generates passive income, can the net operating loss be carried forward to offset against future ordinary active income, or will it apply to only passive income? For example, if the individual qualifies for REP or invest in short-term rentals. So Aman answered, net operating loss from long-term rental generates passive income, can be carried forward to offset against future ordinary active income. No, that's not correct. So passive income, passive losses, depreciation is passive losses. Only if you are a real estate professional in the year when that loss incurs can you use those losses against active income in the future years. So to make that more simple, passive losses can only be used against passive income. Okay, if you have a long-term rental, you get those passive losses from depreciation, right? Those losses can be used in a future year to offset your passive income. So yes, any extra losses are carried forward, but only applied to passive income. Okay, the only way it can be applied to active income is if you are a real estate professional in the year when those original losses occur. Okay, so another great example, when is the best time to do a cost seg? Let's say this year, you're not a real estate professional, okay? And you plan to be next year a real estate professional. You're retiring, you're going to quit your job, whatever, and you're going to go full-time into real estate. So it makes more sense to do a cost segregation in the year that you qualify as the real estate professional, because then you'll be able to use the deductions against any other source of income. Whereas if you did the cost seg this year, when you're not a real estate professional, you get all these extra losses, these extra deductions. You can't use them next year, even when you do qualify as a real estate professional, to offset active income, only passive income. Again, there's suspended passive losses. Yeah, Ayush, have another, someone asked a question. Yeah. Carried passive losses can turn active in future years when you achieve. No. I think I just answered that, BD. It does. They're suspended passive losses and can only be used against passive income, unless you're a real estate professional in the year when those original losses occurred. Okay, I think
I do have a question here, for you too, because the way I understand is when we exit the property, and at that time, that capital gain that we have, that becomes your ordinary income. Is that a true statement? Because then how would the passive losses work against that? If somebody carried it over the 5 years and they say, okay, I'm just going to set it up because here I'm going to get the huge capital gain. And here's like, for example, it's 100,000 and it's $100,000 in depreciation K1. So I'm going to write that off here, right here. So can you shed some light on that too?
Yes, absolutely. So when you sell a property, any gain on the property is capital gain, right? And any depreciation that you took, and we're going to get to this in a few slides as well, it's called depreciation recapture. That's going to incur at the time of the sale. It's not ordinary income, it's capital gain. And therefore, the passive losses you have can be used to offset that passive gain, right? Or those depreciation recapture also. So that's the other case, or the other thing I mentioned earlier as well, that the passive losses can be used to offset passive gains in the same year. Okay, so it's not all lost if you just have all these extra losses. It can be used in the sale. All right, let's see. Yes, passive losses are losses from activities that are not considered to be trade or business tax or real estate rental activities. Passive activities. Okay, thank you. I'm not sure if that's ChatGPT either, but it sounds good. Okay, so what types of eligible property types? So we talked about how different properties can have different amounts of accelerated depreciation. This is a simple, actually I made a mistake over here and I need to correct this for next time, but I have STRs and short-term rentals, the same thing, but they have different amounts over here for some reason. So apartments, multifamily, generally about 28%. And again, it does depend on the type of property. There's a lot of factors that go in there, but this is the amount that we're going to allocate. Once we've subtracted land, the amount that can go into faster depreciation. Okay, the 5-year, 15-year property. So different types of property will have more. Short-term rentals generally have a little bit more because there's more amenities, more, oftentimes more appliances, et cetera. Hotels, again, same reason, furniture, fixtures, there's a lot of that. So we can get up to 35% for hotels in terms of the accelerated depreciation. Other types of properties like mobile home parks, MHP, are off the charts because the majority of mobile home parks are land improvements. And we talked about land improvements being 15-year category. Well, if you don't actually own structure on the land and the tenants own their own homes, you own the land and you own the land improvements, the concrete, pavement, right, et cetera, landscaping, fencing, all that stuff. That's essentially all you own. QSR, that would go into, restaurants over here. Yeah, about 30% or a little bit more. Other asset classes like self-storage, RV parks eligible. Yeah, absolutely. Self-storage. I don't know why it's not on here over here, but this is not a comprehensive list. Any type of property, right? Golf courses, you name it. Any type of property, self-storage you can use depreciation, you can use cost segregation. The only thing that does not apply is your primary residence. Okay. So any other type of real estate, whether it's a business property or a rental property, investment property, it can be used. So what I mean by business property, if you're a doctor, let's say, or you own and you own the building your office operates out of, that's considered a business property. You can take cost segregation on that. If you're a business owner that has a factory, or you're a manufacturer and you own a warehouse, you own a manufacturing facility, you can do cost seg on that. And so the business can actually, that's another really exception to this, where in that case, the business, depending on how the structure is set up, the business may actually be owned to use that. You own the same facility and you can actually use the cost segregation to offset the business income, the active income there as well. So that is another exception to the rule. So Aman is using ChatGPT. Yes. Thank you for admitting that, because sometimes you can just tell, but that's okay. You want to, it's okay to use it. It's just important to also say that where it's coming from, I feel. at least. All your related business, 100%. Awesome. Yeah, BD, awesome. Office out of your house, the use often company. Jason, good question about office in your house. It's a little more tricky. There's different rules that are regarded to that, especially if it's in your own house. So I would talk to your accountant about that. It gets a little tricky there. It's not like a full rental property. But there is another rule called the Augusta rule. You can check that out. Will thinks his question may have been skipped.
It's a recap.
I do have slides on recapture. Yeah, I do have slides on recapture later on. Let me scroll up over here. Oh, recapture bonus region included. Step amount. Phone. Yes. Okay, we'll get to that, Will, shortly. So let's go through this case study. I see we're running out of time here also. So I want to just get through these. But yeah, keep asking questions. Keep it coming. This person bought a property for $1.75 million. It was in North Carolina. This was a few years ago, because obviously right now you can get like a duplex for that amount. But no, it was a multifamily property, and he was able to get a good amount, a good deal from this property. And it was without cost segregation, he would have been able to use about $54,000 of annual depreciation deductions. And how we got to that calculation, again, taking that $1.75 million, subtracting 15% for land, the remaining amount divided by 27.5, that's where you get your $54,000. Okay. But we did a cost segregation study allocated, like I said, to land. The majority is always, again, going to be in the structure, 27.5-year property. That's the walls, the roof, the foundation, the doors, windows, etc. But the 15-year property, landscaping, pavement, fencing, all that stuff, that's 8% over here. And the 5-year property was 20%. So this was a large amount that we were getting. Over 28% of the total property value after land is going to these faster depreciation categories. So the total tax benefit, or the total depreciation deduction with bonus depreciation, was $421,000. Okay, so that's a huge amount, from $54,000 to $421,000. Now, you may be asking, okay, so this is great. I get this huge deduction the first year. What happens in the next year? Do I have no more depreciation left? No. Obviously, we're still taking the majority of the property, this $1 million, spread out over a 27.5-year period. So we're going to be taking, right, over $30,000, $32,000 deductions or so over that time period. So again, you're still going to be, actually, it's much more, because that was on my 850 calculator. It's about $40,000. So essentially, what you're doing is you're reducing your deduction by 28% every other year. Okay, so we're just pulling forward. So you're still going to have depreciation every year, but it's going to be less every subsequent year.
Wouldn't that be a double dip, that you took it up in the first year and then you're still getting the deduction on the 27.5 years?
You're still going to have depreciation deductions on the 27.5-year schedule. All right, every single year.
That's the regular deduction that you're getting, but the bonus depreciation and the cost study that you did, you're getting everything up front.
You're getting the 5 and 15-year property up front.
5 and 15 year, but this is the same. Yeah, but it's the same property, same component, same everything, though. Just wanted to highlight that.
Yeah, same property, exactly. And what we're doing is just we're taking those components that can depreciate faster, and we're taking those deductions earlier on. Awesome. So yeah, this was a huge benefit, because not only did he, wipe out any tax liability he had from this property, but he was actually had, in this case study, the person had a 1031 exchange that failed. And so he had a huge capital gain tax bill and was able to wipe out that tax bill as well. Like I said, you can use the passive losses to offset the passive gain from the sale of other property. Okay. So let's talk about depreciation and recapture. This goes back to Will's question, the stuff most people don't talk about. Okay. There are 3 different rates of depreciation recapture, which means anytime you sell a property, you are going to be subject to what's called a recapture tax. Now, it does not mean that you pay back the depreciation. Probably the biggest question I get all the time, or misconception on recapture, is I have to pay back the depreciation. No, you don't pay back anything. You take, $421,000 of depreciation. You do not have to pay back $421,000. That's not how it works. You're going to be taxed on the sale on that amount. So instead of paying income tax this year, I'm going to take those tax benefits, use those to reinvest, et cetera. And then whenever I do sell, I'll be faced with a tax on that amount. So 3 different rates. Okay. One rate is on a capital gain tax rate, which is much less than your income tax rate. Anyways, usually the second rate is on your ordinary income tax rate. And so this is the difference between if you've done a cost segregation or not, whether you'll have this breakout. And then there's a third rate, which is too complicated for me to explain over here, but it has to do with the 15-year property and is essentially a balance between the ordinary income tax and capital gain tax rate. So essentially, those 3 rates are going to be calculated whether or not you did a cost segregation study. And there are ways to defer or offset this. So recapture does not mean you're paying it all back. And it doesn't even mean that you are going to have to pay the tax on all of it at the sale. What it does mean is that you have to plan accordingly. What it means is that you have to be aware that this tax is going to come if and when you do sell a property. However, if you do a 1031 exchange by exchanging one property for another, and there's special forms you have to fill out to do that, and a time windows, et cetera, but you can defer not only your capital gain tax, but also your recapture tax. So that's one way to do it. Opportunity zones, as Will mentioned earlier, is another great way to not only defer your capital gain tax and defer that recapture tax, but also completely wipe it out. If you hold the property for 10 years, you totally wipe out any of that tax liability whatsoever. And then there's something called partial asset disposition, which I alluded to earlier, which says that if you have done a cost segregation study and shown that 20% of the property is going to these faster depreciations, 5-year property, and you held the property for 5 years, guess what? You can fill this form that shows all those items that I depreciated already and wipe those off the books, which means you're not going to have recapture tax on any of that. Okay, recapture is only going to be on the structural components or the land improvements that are going to be much, much, much less. So yeah, doing a cost segregation and doing this partial asset disposition actually, in many times, reduces your recapture tax. And so you're essentially getting the best of both worlds. I mentioned earlier, other passive losses. If you do a cost seg, and this is the reason why cost segregation is most beneficial for someone who's not just like a one property person. If you just buy one property and that's it, and like every 10 years you buy a property, cost seg is probably not the best strategy to use. But if you intend to or plan on buying properties year after year, then you can use these losses to offset the income from the next property. So you do a cost segregation on the new property, use those losses to offset the gain from the sale of a different property or the income from a different property. Again, so it's all lumped together, and it's really important to understand there are options, and it's important to plan accordingly. Okay, my voice is kind of going here. I don't know if you guys can tell, but that's okay. We are pretty much done. So this is taken directly from the IRS's Cost Segregation Audit Techniques Guide. So if you want to Google that, you can do that. It's great reading. If you have insomnia, I highly recommend it. And you can just see what needs to go into. I mean, cost segregation is not something you can just do on the back of a napkin. It's not something you can just, throw a dart at the wall and say, okay, Yona said I can take 20% off my property, put it in 5-year category. No, there's a whole study that's involved, a whole nomenclature, a numbering system. You have to basically show your work. It's like an 80, 90 page report that we're putting out, which shows all the calculations and all the different assets and how they're allocated, et cetera. Okay, so that's a little bit about us. 4 billion tax savings, yada, yada. Okay, questions?
I'm going to ask you one question here.
Yeah.
What would it look like from the LP standpoint? Because LP, let's say somebody invested 100,000 and we get the 100% depreciation year one, we get the $100,000 tax credits year one, right? And then they are not basically paying any taxes on their passive capital gain. So, but what would it look like? What is the whole scenario, if you can shed some light on that? Yeah,
essentially, if you are a passive investor, you are going to receive depreciation according to your percentage of ownership, meaning according to your equity portion of the property. So let's say, you just keep it simple. There are 10 investors and everyone invests, $100,000 and, it's $1 million property and everyone's going to get, 10% of the total depreciation, right? You take $230,000 of depreciation, everyone's going to get 10% of that, right? $23,000. That's going to be their upfront deduction. So pretty simple. It comes much, and again, that was a really bad example because that was an all cash investment. And so it didn't really, you're like, oh, only $23,000. I thought you'd get much more. So this is where leverage comes into play. If you buy a property with a loan on it, you're taking the depreciation based on the purchase price, not based on the equity. Okay. So the same scenario where we have, 10 people, 10 partners, and they buy, they all put $1 million into buying a $4 million property. Okay. So now we're taking a 25% equity versus the 75% loan. Now we're taking $4 million. So instead of the $238,000, we're talking about over $1 million of depreciation in the first year. Because again, we're just multiplying that by 4. Now divide that by 10, everyone's going to get over $100,000 of depreciation in the first year, the bonus depreciation. So again, that means you can many times get back equal to or more, some obviously many times less, but equal to the amount you invested as a tax write-off. Now, that's not really going to help you much okay, in terms of using those deductions, like we talked about earlier, unless you are a real estate professional or unless you have other passive income or other passive gains. Otherwise, that deduction is just going to, reduce your taxable income from your passive income and then carry forward as a loss to future years.
Wow,
All right.
that was really, really insight. Anybody has any questions? I'm going to open it up for everybody. Please unmute yourself and ask the question.
Don't all speak at once. No, this has been great. Vinky, really appreciate you having on. And by the way, if you guys aren't connected with me on LinkedIn, please shoot me a quick note over there that you were part of this, and I'd love to connect with you there. I'm also on Twitter, Instagram, Threads now. Threads, anyone heard of that? Okay, brand new from yesterday. But yeah, please reach out. I'd love to connect with everyone. Love to help if anyone wants an estimate. Happy to talk.
There is a question in the chat.
Yes.
To discuss incorporating 179D and 45L into cost seg?
Yeah, absolutely. So I'm not sure how relevant this is anymore because some of this has been discontinued. But essentially, these are different tax abatements or tax credits based on certain types of solar or other types of environmental friendly type investments. So essentially, if you buy solar paneling, for example, right, for your house, you can take that as it's called a Section 179D deduction. It means you can essentially write off the entire amount. I'm not sure if that still applies. I know certain portions of the 179 deduction were done away with in the CARES Act, but I don't recall.
Please feel free to connect. And Chad has a question. Chad, unmute yourself, please.
Hi, Yona. My question is, how much on average does it cost for someone to do a schedule, cost segregation? Because I know that's part of it as well, right?
Sure, absolutely. And it's ever changing, obviously, but it's not based on tax, not contingent to tax savings. So every company is a little bit different. Our firm, basically single families will start around $3,000 up to, for commercial properties up to about $5,000-$6,000 on average. Some larger commercial properties maybe up to $10,000, but generally speaking, around the $5,000 range. $5,000-$6,000 is the general time. I mean, obviously, it's gone up over the years with inflation and everything else like that. But I think Madison Specs, like I said, we're the biggest national company. I think we're even on the lower end of the spectrum when it comes to pricing.
Lenny, you're next.
Yes, thanks, Yona and Vinky. If are you able to do the cost segregation if it was done by the previous owner and say they took it very early? I just wasn't sure if that was still something that you could take.
Yeah, so depreciation starts over with every change of ownership. So it doesn't matter at all that the previous owner did it. You get to do your own depreciation, your own cost segregation when you become the new owner.
All right, and
go ahead.
Yeah, so I can't remember because we're both fairly new at this. There are a couple things that were brought up in a bigger deal that we're on, is that they could take a 200%, which I'm not quite clear how that happens, and or the main partners or the major partners are forgoing theirs, so they leave it, they allow the rest of the general partners to take the bonus depreciation. I'm not sure exactly how that works.
I'm not sure either. I'd need more information on that. But oftentimes I've seen many pitch decks and many things where people are kind of pitching cost segregation and different types of returns, et cetera, tax benefits, and many times they don't really understand how that breakdown actually works. So always consult with your CPA. Always consult with someone who understands the fine details and make sure they themselves know what they're talking about, because that, again, doesn't make a lot of sense to me, but I'd need more information.
Okay, thanks. I'll take it offline.
Yeah, and the other thing I was going to add to it was I learned from somebody else that you can do the cost seg after exiting the property too. I think you have 1 year to go back even after you sold the property. So within a year before you're filing the taxes, you should be able to do the cost seg. Correct, Liana?
It is a little complicated doing it like that. It's obviously much more reliable to do it when you still own the property. But yeah, I mean, theoretically, as long as you before you file taxes for that year. So meaning you cannot do it in another year, right? You have to do it in the year that you actually own the property. So let's say, right, you've owned the property for a few years, 2023, you sell the property in July. Okay. Right now you sell the property. You could theoretically still do the cost seg later on to apply to your 2023 taxes, even though you've already sold the property. I think that's what you're saying.
Mm-hmm. Yeah, exactly. So any more questions for Yona? If not, we are at the top of the hour. Thank you so much again, Yona. I really, really enjoyed it. It was such an insightful session. And thank you everybody for joining. We'll see you next time in 2 weeks with another awesome guest. Bye.
Thank you so much. A pleasure.